Hey everybody, happy Friday, March 6th. It's a little bit after 1 p.m. on the West Coast, and it's time for another market update. I had to stop myself from saying Thursday. I'm so used to doing these on Thursdays, but I was lucky enough the last few days to attend an amazing seminar in Vancouver, Washington, that was done by the Murdoch Trust, which is a great nonprofit giver, funder, you could say, in the Pacific Northwest. And I was there on the behalf of Habitat for Humanity, La Pine Sun River, which was an amazing experience. A lot of great people, inspiring stories. If anybody's interested in giving to Habitat for Humanity, we always need money. So look us up on Google, the Habitat for Humanity La Pine Sun River. Anybody here in Central Oregon or anybody watching out of the area, always more than welcome to donate. But I had to come back from that amazing, inspiring experience to come back and talk about war and oil prices and things. So this is going to be a quicker video. There's just two main topics I want to talk about. And one is this, because these are just two main things are driving the markets right now. And one is this war going on in Iran, and what has happened to oil. So today, crude oil prices jumped to a 14-month high, over $80 a barrel. You can see obviously where it spiked right there. You can guess that was where the start of all this conflict. And like we talked about, oil is obviously connected to gasoline. Gasoline has a lot to do with inflation in this country. They try to get energy costs out of the core number, at least, like when we talk about inflation. But it's really hard to get energy prices out of prices. Any goods that get delivered in this country at some point are on a truck, that's going to cost gas. All that stuff gets passed along and gets part of inflation, passed along to the consumer and so forth. So oil prices jumping up are not good. Oil prices are not good for inflation. Inflation is not good for mortgage rates, because the higher inflation is, the less likely it is that the Fed will cut their rate coming up. This in a few weeks, or even in the next few meetings. So we do not like war for that reason. And like I try to explain, people, investors like no volatility. They like calmness in the market. They like to be able to put their money into markets and know what's going to happen and not be worried about crazy wars breaking out or things like that. So that also has an effect on the markets. I'm sure you've seen the stock markets had some issues, Bitcoin, all that kind of stuff. So people just don't like volatility. They want calmness, because if you know what you're going to if you know you're going to get a return on your money, that's a great investment. If you're not sure what's going to happen when you put your money in, that's a little bit more risky. So the war with Iran and what's going on in over in there with the Strait, and oil, going through the Strait and so forth, is having a big effect on the markets and will show up in inflation, and it's definitely showing up in mortgage rates in the short term. Next thing I want to talk about. Today we got the BLS Jobs Report for February, and it was a huge miss. It was a really low number. It was actually a negative number. It was supposed to be around 55,000 jobs created, I think, and it came in at negative 92,000 jobs. Unemployment jumped up from 4.3 to 4.4. They made negative revisions once again to the previous 2 months. This, if war wasn't going on, would have been a great day for rates. As you know, we have got down below 6 before this, all this stuff started happening with Iran. That made them, jump up, which we'll talk about in a second. And then this jobs report, if we were in a normal environment today, if this came out this week, this would have definitely been something the markets would have rallied on. They did for a second, but then there were some comments made about, how we would protect oil and what we would do, and how long the war is going to go on and things like that, that spooked the markets. And from that point on, the day turned red for us. It was not a good day for mortgage rates. When you see a negative 92,000 job report in a bubble, if you told me 3 weeks ago we would get a negative 92,000 job report, I would be very happy and think that would be a really good day for mortgage rates. But unfortunately, that did not happen. So those were the two big main things. Like I said, war really has got everybody's attention, whether it's for the awful humanitarian reasons. Obviously we don't want to see anybody get killed, or when you're just looking on economic reasons, because it's an area where a lot of the oil in the world comes from. So that is basically dominating everything right now. And until that settles down, some of this data is going to fall to the wayside a little bit more. So where does that leave us? So last week we were at 6.05. We had come up a little bit after dropping down below 6. We're at 6.14. So again, heading in the wrong direction. Not the worst. Again, it could be worse. Obviously, we could be getting even higher, but not good to see. And like I said, just the volatility really spooks the markets, especially with a Fed meeting on the horizon. So speaking of that, that's coming up in a little bit under, let's see, about 2 weeks or so. We got CPI coming up next week, and then we got the Fed middle of next or 2 weeks from now, where they're right now the markets are saying they're going to pause, they're not going to cut their rates. Again, this jobs report would have been one of those things that maybe that would have changed their mind. But whatever everything else going on in the world, right now the markets are pretty locked in. Again, things can change always, but that they will keep their Fed rate the same, which again then trickles down to mortgage rates. So crazy stuff going on in the world. Let's all just try to like make our part of the world better, and that's all we can do. And let's hope for better mortgage rates in the future. Have a great day, guys. Thanks a lot.